County Board of Equalization hearings. We have 4 board members present. Mr. Hoffman is not here today, and 6 cases on the agenda. The first case is RPC 34024-339 at 1401 South Clark Street. Mr. Kim, you can start with your 8 minutes and tell us about this property, sir.
Thank you very much, and good morning, everybody. The subject property is a Class B office building located in the Crystal City submarket. It was built in 1970. The property has 276,000 square feet of rentable space, consisting of 272,000 square feet of office and about 3,500 square feet of retail space. As of the date of value, the property was 63% vacant, an increase of 5% year over year. This is a distressed asset with significant near-term rollover risk. The tenants in place currently have a weighted average lease term of less than 3 years, which creates real uncertainty around maintaining and building future income levels. To derive our opinion of value, we performed an income approach to value the property in accordance with the DREA 2025 office guidelines. We incorporated 2 major changes compared to the county's calculation. The first being the vacancy rate. Our analysis updates required below the line vacancy adjustments to account for the accurate levels of vacancy at the subject property. If you look to the test column in the revised worksheet in column F, you will see that the county made adjustments below the line to account for the accurate excess vacancy achieved in 2024. So with these changes, we're left with really only one major discrepancy between the county approach and our approach, which is the cap rate. We increased the assessor's cap rate of 8.2% to a base rate of 9.59%, which we have included extensive support for, and also falls within the county's guidelines for the Crystal City bid and national landing market. With these 2 changes, you'll see in column G of the appellant pro forma approach, we arrive at a value of $31.68 million. We believe the increase to the cap rate is well justified within the Arlington County guidelines. Based off the Crystal City bid and national landing market, the highest cap rate that you can apply is 10.79% loaded. Furthermore, the Corpex cap rate study commissioned by the county indicates a cap rate range of 7.32% to 11%, with an average of 8.8%. This property was built in 1970 and is currently in significant distress with over 60% vacancy. As mentioned previously, the weighted average lease term for the in-place tenants is less than 3 years, and bringing this property to stabilization will require a significant capital investment. Given the age and distress at the property, the cap rate applied should fall on the upper end of the range identified by the study, not below it, which is why we have indicated a base rate of 9.5%. If you look to page 5 of the Ryan submission, you will also see a band of investment calculation which supports a 9.5%. Additionally, the property was appraised in the second quarter of 2024 by an MAI licensed Virginia appraiser. You can see on pages 7 of the packet that we submitted, the income capitalization approach indicated by this appraisal is $31.8 million, and the sales comparison approach is $31 million. Additionally, ownership engaged 3 separate brokers to complete opinions of value up for the subject in March and April of this year. All 3 reports indicated significant deviations below the current assessment, as well as our requested value of $31.6 million. The Eastdale secured broker's opinion of value estimated range between $9 million and $13 million. Cushman & Wakefield estimated value range between $14 million and $17.5 million. And JLL estimated value range between $13 million and $15 million. Given the proceeding and all the evidence we've submitted in our packet, we believe that the requested assessment of $31.687 million is well justified and supported by the calendar year 2024 appraisal. That's all I have. Thank you.
Okay, thank you. And Mr. Bynes for the county, please.
Yes, good morning, board. Good morning, Mr. Kim. Yes, as he stated, this property is a Class B office building that was built in 1970 and with renovations, has an effective age of 1989. On September 19th of this year, Ms. Libba McCraw and I inspected this property. Today, I would like to start on the summary sheet, which is located on page 4 of the BOE packet. I did review the 2024 income and expense survey and rent roll submitted by the appellant. I would like to start on column E1, which we did reconstruct just to add a value to the vacant office for the property, just for better comparisons. We did see that there was more vacant in LA than we had in column D, which is our assessment. After going through that, I did conduct a revision for the property. I would like to note that for the office rents, um, the per square foot rental rate was higher than what we had in our original assessment. Also, basically the vacancy was the same, we used the same vacancy rate and the same $8 per square foot operational expense rate. Um, and as you can see in column F, we did increase the below the line deductions for rent laws, TIs, and leasing commissions up approximately $3 million, which brought us to a revised valuation of $40,021,800. Also, I did look at the appraisal that the appellant did send to us. I did ask for the full appraisal and did include it in the BOE packet. So if we look at page 128 of the BOE packet, I did see the mention notice of planned capital expenditures that were detailed for approximately $7.9 million. If we go to page 141 of the packet, this shows the direct capitalization analysis used by the appraiser. This method is similar to the methodology used by the county. Uh, if we look at the rental income per square foot, we can see the appraiser and the county were almost the same. Also, if we take a look at the final valuation of where it came out to approximately $31 million, we can see the appraiser took the $7.9 million of planned capital expenditures below the line. If we do not include that, we can see the indicated value is $41,290,900, which is slightly higher than our revised value. Also, if you take a look at their sales approach, we can also see the 7.9 million was also taken below the line. And I would like to note that also, if we look at the cap rate used in the appraisal, the appraiser actually used a lower base cap rate of 7.75, which is lower than what the county and the county used in their evaluation and the appellant used in their pro forma. Also, our cap rates are supported by sales data and third quarter commercial real estate publications such as PricewaterhouseCoopers, RERC, and CBRE. The fourth quarter was not available for the 2025 analysis period. With that said, we'd recommend that the 2025 assessed value be revised to $40,021,800. Thank you.
Okay, thank you. Questions from board members? None? Okay, Mr. Bynes, any final comments in your minute to wrap up?
Yes, I just want to reiterate that we did take into consideration the excess vacancy that was additional compared to our original assessment. According to and I would like to note, even in the appraisal, the appraiser and their income approach and sales approach was similar to our valuation, not considering the planned capital expenditures. Thank you.
Okay, thank you. And Mr. Kim, if you take a minute to wrap up, sir.
Yes, thank you. I would like to note that the cap rate we're asking for is well within the county guidelines. This property underwent some minor renovations, but it was built in 1970. It's an aging Class B office building. And to bring this property up to stabilization, you will need to spend a significant amount of money, which the appraiser did account for in justifying the valuation. Given the Arlington County model, we can't adjust for this excess capital below the line, which should warrant then an increase in the cap rate to bring the property to what should be the fair market value. Just two different ways of arriving at a similar conclusion. And we're not asking for a cap rate outside of the range. We're asking for one adjusted to the higher end of the range within Arlington County. The upper end of the range is 11%, and we're asking for a base rate of 9.5%, which I think is fairly reasonable given all the negative headwinds facing this property. Thank you.
Okay, thank you both. All right, it's just among the board. Where are folks? Mr. Mendez.
Yeah, I would agree that the property's in trouble. It looks like at least for the last 3 years, it's been close to 60% vacant and rising. So I did a calculation where I bumped up the cap rate at 0.5%, and it was a slight reduction to 37,301,100. I'll see if anyone agrees.
Okay, Mr. Yates or Mr. Penaranda? Mr. Penaranda.
Yes, good morning. To be honest, originally I was okay with the original assessment, but I see that, even though the NOI on the worksheet on the revised is a little bit higher, the concessions that are being given below the line are, in favor of the appellant. So I'm okay going with the revised assessment the way it is. It is a decrease anyway from last year, and significant deduction. So I'm okay with it.
Yeah, I agree. I'm with the revised. Mr. Yates, where are you?
I honestly could go with the 50 basis points, given the fact that it is 63% vacant, and it's running that way. And they did lease up 2 units this in 24. I think it was, if I remember, it was like 14,000 square feet. So that's hopeful, and they were at good rents. But the fact we have tended to go with the 50 basis points for high vacancy properties, and this one clearly is with, it's 283,000 square feet, and that's a lot of space to have that much vacant space in. I'd go with the 50.
Well, unfortunately, we're at
I know.
2-2 here. And so here's our dilemma. If not, it goes back to the original, which I certainly don't want it to go back to the original.
I will flip the other way to keep that from happening. And Johnny, you can vote no.
All right. Then, Mr. Penaranda?
Sure. I'll move that we reduce the assessment to the revised number of 40,021,800.
All right, I'll second. All in favor? Aye, opposed? Okay, it's 3-1 without Mr. Mendez. The county's revised number of 40,021,800 has been confirmed. Okay, and the case is the same agent and appraiser, RPC 34027-016. Mr. Kim, you can start with your 8 minutes and tell us about this property.
Thank you. The subject property is a Class B office building located in the Crystal City submarket. It's built in 1981. It has 134,000 square feet of rentable space, of which about 2,800 square feet is retail. As of January 1, 2025, the property was 93% vacant, a massive jump up from 74% vacancy just 1 year prior. We applied an income approach to value per the Arlington County guidelines, and similar to the last case, our two primary issues were the vacancy and the cap rate. Here, we adjusted the below the line vacancy adjustments to account for the excess vacancy within Arlington guidelines, and then increased the base capitalization rate by about 50 basis points. This indicated a final value of about 4.3 million. If I can direct you to the test column F, you will see the county's revised pro forma approach, in which they adjusted for the excess vacancy, the actual excess vacancy that was reported on the I&E submission. If you look down column F, you will now notice there's very few differences and discrepancies between the pro forma we provided and the county's test column. Their pro forma indicates a value of $5,369,900, which is very close to our requested value of 4.3 million, with the only difference being due to the cap rate. Despite the test column and their income approach indicating a value of 5.3 million, they recommend to the board to enroll the land value plus a nominal $1,000 for the improvements. The key issue with this is that it now takes this operating office out of equalization with other offices within Arlington County. The revised income pro forma should serve as the basis for the assessor's recommendation to the board, not them switching it to a transition property where they're now considering it the highest and best use as a redevelopment play. If you were to look at this as a highest and best use case, the proposed valuation ignores the cost associated with demoing the building that currently sits on the parcel. There are two tenants in place at this building. One is Arlington County with a lease through 2027. So this building, if it was a highest and best use case and it would be cited for redevelopment, there would be significant costs associated with demoing the building, which the county is not accounting for in their approach. If you apply a demo cost of $25 per square foot to the building's FAR of $144,000, and then detract that from the land value, the county's land value, you end up with a value of $5 million, right around what their test column indicates and what we are requesting in of our value of $4,340,000. So to summarize, we would ask that the board either enroll the county's test column, which is in line with the actual performance, or that they acknowledge that the cost of demolition the property, which would be roughly around $25 per square foot from what we've seen within the market. Thank you. That's all I have.
Okay, thank you. Mr. Bynes for the county, please.
Yes, I would like to start by referring the board to the page 6 of the BOE packet. This was the rent roll provided by the appellant. As they did say, this property is highly vacant, around 93%, almost 93%, vacant. We do recognize that, and that's why I did create the column F test column. And as we can see, we added almost $4 million worth of below the line adjustments and rent loss and TIs and leasing commissions, which did come out to a revised valuation of $5,369,900, except for, now I would like to note that this is well below what the land valuation was for this parcel at $8,648,500. If we do recognize that this property has had many issues, chronic vacancy, not being able to lease up any new tenants. If you look at page 7, we did use a cost approach. This was done to make a comparison value between versus the income approach. The total cost depreciated value of the building itself was slightly higher than the total assessment when using the income approach without applying the below the line deductions. I would like to note that it would be hard to believe that the owner would sell the property for less than what the land is valued, even with demo costs that may be incurred by a potential seller. And with that, we did reduce the improvement value to minimum value of $1,000. And with adding that to the land value, we do recommend a revised assessment of $8,649,500. Thank you.
Okay, thank you. Questions from board members? No? Okay, any final comments, Mr. Bynes?
Yes, again, I would just like to say that we do recognize the chronic vacancy issues at the property and the struggle to attract new tenants. We did lower the value of the building to a minimum value of $1,000. Do not believe the land has lost its value based on the vacancy issues of the building, and also without a site plan, it's hard to determine what the redevelopment value would be for this property. With that said, we do again recommend a revised value of $8,649,500.
Okay, thank you. And Mr. Kim, if you take a minute to wrap up, sir.
Yep, thank you very much. So we're not arguing that the land value or the land is not worth 8.6 million. We're arguing that the building on top of the land detracts from the site itself. This is a chronically vacant office building with no future prospects of leasing it up. So this building then takes away from the actual value of the site, and that should be accounted for if you're going to look at it as a transition property or a redevelopment play. The cost approach that was briefly mentioned, this is a significantly older building, and no investor or market participant is going to look at this to value the site as what it was cost to build in 1981. So we would ask the board to either, once again, look at the income approach that was done in the test column by the assessor, or factor in some sort of discount to account for the improvements on the site that are detracting from the land value. Thank you.
Okay. All right, thank you both. Okay, just among the board. Mr. Yates.
We've seen buildings in the past that have site plans and are set at these kind of values, which do require the demolition. But that's included in that value already on the land. I don't think it takes away from the land value, and $25 a square foot is way too low. I understand exactly where the county came from.
Okay. I'm actually leaning more towards the revised number, but let's see what other folks. Mr. Mendez?
I think it's hard to tell because, like the county said, would the owner sell it for less than what the land value is worth, and what is someone willing to pay to come in and buy the property? I don't know what could be built on top of it, so it's hard to factor in, what the demolition cost would be and if they could make it up. So with that, I think I'm with Mark. I think I would stick with the land value plus 1,000.
Okay, Mr. Penaranda?
Yeah, I agree with that. I don't think it would be the first time that we're looking at a case like this, to be, because it just doesn't make sense that it would be worth, less than the land value for any building in the county. So yeah, I'm okay with the revised test and the approach that the assessor took on this one.
All right, well, I realize I'm swimming upstream here, but just, I mean, the whole issue of, you got a lease in there to 2027, it just seems like I could see this if this was next year. That'd be different, but I don't know. I don't feel comfortable with it. But the three of you've got the vote, so
Well, I do think they do buy out leases, especially short-term ones like that. Plus, we looked at one, I want to say it was even last week. There was an existing building that was vacant. And we talked about the demo cost, and that did not bring down the $60 a square foot. Now it had a site plan. This isn't there yet.
right.
This, but I don't think $25 a square foot's a realistic number.
Okay, all right. Somebody like
Oh.
to make a
I will. I'll make a motion to go with the county's revised number of, and I'm sorry if 8,649,500.
so that's by adding
Oh,
the $1,000 to the
plus.
land value.
Yes.
Okay, I got a motion. Do I have a second? Okay, motion and a second by Mr. Mendez. All in favor
All
and opposed. So it's 3-1 without myself. But the county's recommended number of using $1,000 added to the land value of 8,649,500 has been confirmed. Thank you, Mr. Kim. We still have Mr. Bynes, and then do we have Mr. Warren, I believe I saw on earlier.
Yes.
Okay. All right, moving to the next case is RPC 20013-027 at 4301 Henderson. Mr. Warren, you can start with your 8 minutes and tell us about this property.
Before I start, Mary, were you going to?
We're going to do that
at
the end.
at the end?
We'll do it
Okay.
at the end. Yeah.
Okay. Okay, thank you very much. I am going to start on the county's board memo response, page 32 of 115, which is our summary of facts for this property. This is the Henderson Park Apartments. It's located at 4301 North Henderson Road. It consists of one tax RPC, currently assessed at $34,984,300. The county is recommending a revision to $33,095,700, and our requested value is $26,869,200. The property was originally built in 2012, 66 total units, and what we would classify as a low-rise or garden. The county classifies this property as a mid-rise. It is one building and 4 stories. Looking over at page 3 of the apartments, the county's apartment I&E summary, you'll see, and one, just going back to the 2025 original assessment, that 2025 original assessment represents a 5.1% increase above the 2024 assessment value. However, when you're looking at actual NOI, and you can see it here in column E as reported, it decreased 4% year over year from the NOI that was reported the prior year in 2023. The counties, and this is very similar to the cases that were heard last week, that the county is, for these properties, these are, again, very stabilized properties in terms of occupancy. However, the county is overshooting the gross potential income in their original and test columns here. Now, in their original assessment, the county was estimating a gross potential income of $2.93 million, and you'll see it decreased slightly in their revised test column down to $2.9 million. However, also you can see in columns A, B, C, and E, which are the actual reporting, I&E reporting for the past 4 years, that the property has not exceeded $2.8 million in any of those last 4 consecutive years. And in fact, most recently reported a gross potential income, yes, of $2.8 million. In terms of operating expenses, the again, a very stabilized operations and are showing a consistent uptrend in the actual expenses that have been incurred at the property over the last 4 consecutive years. And most recently, reported operating expenses of 34%. The county's original assessment valued this property estimating a operating expense of 28%. They did increase that to 31% in their revision. However, it's still significantly below the actual expenses that were incurred at this property in 2024 of $936,000. The net operating income, the actual net operating income that was reported at the property was $1.82 million. The county's revision NOI of $1.916 million is approximately still $100,000 away from what this property was actually able to achieve most recently in 2024. Again, similar to what we've previously stated on some of these cases with the owner, which is a similar owner to the cases that were presented last week, is the county appears to be for these properties that have a stabilized occupancy overshoot the gross potential income, but don't align the operating expenses in their revision or test column with that same increase year over year, which is supported by the actual I&E statements for these properties. With that, I'll conclude. Jeremy, I don't know if there's anything else you want to add.
Hey, just really quick, we put all these things in the test column and then we look at the value and make sure it makes sense. And we're at $530,000 per unit. We saw some larger unit properties last week that were in the high 400,000s, and we were complaining about them. This one's even higher. There's also, it's a little confusing because when the assessor recreates the income and takes it in this case, $100,000 higher, it's based off of the rent roll and then looking at the actuals. And if you look at the page after the history, it shows the rents being applied. But the page after that, I think, is from a different property because the unit mix doesn't match and the unit count is wrong. So when you look at it, it says, well, the 2 bedrooms are 2778 average, and the 2 bedrooms being used are 2,900 and 3,200. So I think there might have just included the wrong rent mix there. But if he did, and the average is actually 2778, and they're using 29 and 32, obviously that's assuming that you can increase rents by 20% seems extremely aggressive. So just a bit confused on that. But either way, it results in a gross potential income $100,000 higher than the property's ever done, and the gross potential income at this property is up 40 grand from last year. So it went up $40,000, and now we said, well, it should have gone up an additional 100. Seems extremely aggressive. That's all.
Okay, questions from board members? Oh, I'm sorry.
I didn't go yet.
I just caught myself. I'm sorry, Mr. Vines. Go ahead.
No problem. All right. Yes. Good morning, Mr. Warren. Good morning, Mr. Chitlick. Yes. So this property is a mid-rise apartment that is in the appellant's stated in their appeal packet. The property has 4 stories. In the 2025 commercial guidebook, it states that multifamily units with 1 to 3 stories are considered garden style, and the units with 4 to 6 stories are considered mid-rise. And the garden style has a vacancy and collection rate of 6%, and mid-rise has a vacancy and collection rate of 4%. I would like to also state that, yes, I want to clarify error that was made on the rent roll analysis in the BOE packet. And incorrect rent roll analysis was included in this packet. If I could share my screen really quick, I'll just like to, let me share my screen. Just want to show here, here's the correct rent roll analysis that we use. If you can look at the worksheet that are created and at the rents, we can see for the 2 bedroom plus den, and a 3 bedroom for the worksheet, I did use these rents plus 2.5% increase for 2025. And for the 1-bedroom, I did use the same rental rate. See here. I would like to go to the summary sheet on page 5. I did review the income and expense sheets that was submitted by the appellant. If we take a look at column E1, I did reconstruct the expenses just to remove 23,500 for CapEx expenses and $61,046 for state income tax that was included in the expenses, as these aren't allowable by the county. And this reduced the expenses were 33, almost 34% at the 33% for the year. I would also like to take you to our revision. For the apartment rents, this was their apartment rents from the rent roll plus 2.5%. And the property was 97% occupied as of the January 1, 2025. Also, the vacancy rate we used was 4%, and in their pro forma, they did use 6%, but the 4% is correct based on the classification of the property. This led to an EGI that was approximately a little over 1% greater than what was achieved in 2024. For the expenses, we did use 31.1% ratio for that, but this came out to total expenses that were 3% higher than what was achieved in 2024. And if you go back and look at the previous years in 2021, you can see expenses were 29.18%, 29.89%, 29.65%. And so there was quite a spike in 2024 of expenses. We go to our expenses, the total expenses are more in line with what happened in 2024 as a gradual increase that can be projected. Also, if we look at their NOI, it was 0.5% increase over 2023. But if we go back to the previous years, we can see the NOI increased 10.6% in 2022, 10.404% in 2023. And in our revised column, the NOI was increased 0.78%, which I believe is really reasonable for property that's highly stabilized. And let's see. And with that, this led to a revised valuation of $33,095,700, which was a 5% reduction in the assessment value. With that, recommend that, and also this value is lower than the 2024 value. So with that, I recommend the 2025 assessment be reduced to $33,095,700. Thank you.
Okay, thank you both. Questions from board members? No? Okay, any final comments, Mr. Bynes?
Yes, I would just like again to reiterate that this is a mid-rise apartment, and we did take a look at their 2024 income and expenses, and we did make reasonable adjustments to those, and that did come out to a final valuation rate that was actually lower than their 2024. So we do recommend the assessment be revised to $33,095,700. Thank you.
Okay, thank you. And Mr. Warren, if you take a minute to wrap up, please.
Ms. Dooley, I'll wrap up. I know I got a minute. So here's the property. This is not like all the other mid-rise arguments. As Mr. Bynes said, mid-rise is 48 stories. This is 3 stories above a above-ground parking garage. This is not setting a precedence that 4 stories are now. If you look into there, you can see the cars parked on the first floor. And the reason the owner did that, it is easier to build surface parking than it is to dig below and go below grade parking. So this is a parking garage with a three-story apartment unit above it. If the owner had dug down and put the parking garage below ground and brought the building down 3 stories, it would have been a lot more to cost to build, and the assessor then would have called it a garden style because it was 3 stories. So this is a 3-story apartment building. You can see, I'm happy to drive around the building and you can see there is no units on the first floor. There's your lobby, and then you have the balconies. It is a 3-story apartment building with above grade that sits above grade parking. It makes it very difficult to understand why this would be a garden. I understand the other ones. This is not a precedent setting, and this is very different, and our last apartment of the year. So thank you.
Okay, thank you. All right, it's just among the board. Where are folks? Mr. Mendez.
I thought that last the wrap up from the appellant was really interesting. I wish that had been brought up earlier so I could ask the county a question about that. But from the county's definition, it seems like whether they have units or not, it's 3 or 4 stories and up is a mid-rise. So I would have to lean more towards it being a mid-rise. But that said, I do see where the appellant is coming from as far as the income looking like it's being grown, just to account for that 4% vacancy. So what I did was I just used the apartment income from E1 because it seems like the county and the appellant agree on that, and I just plugged it into column F, and it was a slight reduction to 31,423,700.
Mr. Yates?
Initially, I agreed, and I was looking at it the way Johnny was. I saw it maybe 50,000, the revised about 50,000 too high on the income. I was glad to hear what the county said as far as what they did with the rent rolls and what was in the document. That was a question I originally had. But I think with the rent roll they used, I think they're correct. I have a problem when the appellant does their pro forma for the future year and bases it on total flat rents coming from 24. I mean, I don't think that's honest. I don't think it's fair. Let alone the 6% versus 4. I understand that argument. That's a good one. But I end up at the end of the day, I kind of reverted back and went with the projected or the revised number from the county.
Okay, Mr. Vanderanda?
Yeah, I was pretty much doing the same. Because looking at the vacancy, I was trying to see if that would be a fair adjustment to go to at least 6% on the revision. But this is, to me, in my opinion, this is a property that has been, like the appraiser said, it's just, it's an unstable building, and income has been increasing year after year. NOI has been increasing year after year. So even with the adjustments I was trying to see, I don't really, I don't feel comfortable justifying just that number. We have to increase also the expenses to be able to come up with a number that would be similar to their, actual numbers. So I'm okay with the revised assessment the way it is. It is a decrease anyway.
Right, I agree. Does anybody want to comment on the last argument that the appellant made about the garage being one of the floors?
I kind of looked it up while we were talking, and it doesn't say anything about apartments there. That's the problem. And maybe that's something the county needs to address going forward.
It's not, I mean, like, even when I went and looked at the Fannie Mae guidelines and whatnot for it, it's similar, like when you get a, because this is where people want to come and argue 3 to 4 stories. The same thing when it goes over 7 stories. And sometimes people will say, oh, but one of the stories has, workout rooms. It doesn't have apartments. It's still a story. So to me, a story is a story. It's kind of back, Jose will remember back, if it looks like a carport, you know, there's pictures of the carport, it's carport. So to me, it's 4 stories, whether it's garage or housing. So I don't have an issue there, but I agree with you all on the, the county's revised number. So I think we can move forward on that. So I guess I will. So I will move to confirm the county's revised number of 33,095,700. Do you have a second?
I'll second that. It would be a reduction, right?
Yeah, the county's revised
Okay.
reduction. Okay, motion and a second by Mr. Penaranda. All in favor? Aye, opposed? Okay, and so it's 3-1 without Mr. Mendez. The county's revised number of 33,095,700 has been confirmed. Thank you. Okay, next case is RPC 34020-275, 241 18th Street South. Okay, Mr. Warren or Mr. Chitlick, whoever is going to start, you can start with your 8 minutes.
Okay, and I'll start. I'm going to start on page 26 of 139 of the county's memo response, which again is our summary of facts. Property is located at 241 18th Street. It's known as Crystal Square, Crystal Plaza 4. It's consistent of 1 tax RPC. It's currently assessed at $116,517,400. The county is recommending a revision to $112,352,700. The property is an older property, originally built in 1980. It's 524 square feet of office and retail space. The property is within walking distance of the Crystal City Metro Station. Turning now to page 3, which is the county's income and expense summary analysis. You'll see the column shaded in light blue. A, B1, C1, and E1 are the last 4 years of reporting for this property. The 2025 assessment represents a 6% increase from the prior year's value, while NOI has decreased 21% year over year from 23 to 24. The county's NOI from $11 million in their original analysis to $10.6 million in their test column is still higher than significantly higher than anything that's been reported at the property in the last 4 consecutive years, as you can see. With regard to the gross potential income, the history of this property dating back to 2021 has been $13.3 million in gross potential income, down to $13.2 in 2022, $13.9 million in 2023, and then drops down to $11.66 million in most recently in 2024. The property had a couple large vacancies that occurred in 2024 with Amazon vacating some of their suites. They still are retaining some of that space currently. But that is one of the biggest issues here is the county's applied vacancy rate of 13% in both their original analysis and their revised test column. This property has, as of the valuation date, 62,646 square feet of vacancy. Now, of that, there is 18,787 square feet of vacant retail space. The county applies that vacancy rate to the retail rents in their analysis, but they don't use it as a calculation for their guidelines on what a vacancy rate to apply. So when that's taken into consideration, the property is 17.4% vacant, which would indicate a much higher 18% vacancy rate that would apply to the subject property. We use a 23% vacancy rate because in addition to that, there was additional vacancy in terms of the office. If you look at the rent roll, Eagle Hill Consulting, and you can find the rent roll on page 52 and 53. Eagle Hill Consulting, which is 9,959 square feet of space, is indicated as occupied. However, that rent roll is as of 12/31/2024, and the rent roll that was submitted in the I&E survey to the county, as well as included in our appeal package, was highlighted specifically because they were vacating and did vacate as of 12/31/2024 and were vacant as of the valuation date of 1/1/2025. In addition to that, UMD College Park, which had leased 8,300 square feet of space, they vacated in July 31st of this year as well. So all told, currently this property is 20% vacant. And again, the county's original valuation and the revised test column are applying a 13% vacancy rate. Per the county's own guidelines, the county should have applied a 23% vacancy rate, all told with the vacancy at the subject property as of 1/1/2025. With regard to the operating expenses, the county was using $9.50 operating expenses in their original analysis and revised test column. That is in line with the actual operations at $9.65 most recently in 2025. Looking at the net operating income, the county's test NOI, which is $2.3 million higher than what this property was actually capable of generating. If you look at column E2, the county, I believe, has reconstructed the year-end 2024 reporting by assuming a lease up of the vacant office space or the vacant space. However, if you look at the net operating income, it's still $1 million below the NOI in the county's revised test column. So we're still a very far way away in terms of the reconstruction of the 2024 analysis, and that's assuming 100% occupancy. With that, I'll cede the rest of my time to Jeremy if he has anything else to add.
Yeah, we've had a lot of cases where the income's gone up and the assessors predicted what next year will be. In the last case, actually, the comment was made that they felt that our information was using the actuals and being dishonest, which I don't agree with. But the fact is that even if you look at the actuals, the trend here is 11.5 million down to 9.6 million. So we have a trend. If we're projecting forward, it's going to be below 9.6. Anybody looking at this property, if we're looking at projections, it's going to go down. The assessment is up, even if you take the test column, $3 million, despite the income being down 20%. In the reconstructed, 16.2%. This is not well, we'll see a trend and get it next year. This is if we're looking at it the way we've looked at every other property, you see increases. And it's not a one-year blip. The income now is the same as it was in 22. It's right on par, which is very close to where it was in 21. We had it at 10.1 million, and then it went down to 9.9, and then it had a one-year increase based off of how the assessor reconstructed it. And now we're back down to a stabilized number and trending downwards. And the assessor is saying, no, you're going to turn it around. The best you can do, reconstructed, best case is 9.6. We actually think you're going to do 10.6. And the office market in Crystal City is not telling us that. As you heard from Emmett's first case, we work with Emmett. We're the same company. And then the other Arlington office buildings in Crystal City, we can call it National Landing. It's still not a great office market, and the trend is down. So we're trying to give you all the numbers and be upfront and as honest as possible. So if there's any questions on if we've done something incorrectly, please let us know during the question and answer period, and we're happy to answer what we did and why. But a $3 million increase when the income is way down, but not way down, just an anomaly way down to 2022 levels, just doesn't seem right to just assume it's going to go up $1 million. It should take that trend and then be below 9.6 if we're doing it the same way we've done every other case. So that's it for me. Thank you.
Okay. Mr. Bynes for the county, please.
Yes, thank you. I would like to start by looking at the summary page here on page 4 of the BOE packet. If we did, as the appellant did say in column E2, we did reconstruct the I&E just to include the vacant office with a rental rate just for a better comparison. If we do look at column D, which is our original assessment, and the office income that we projected, we actually projected the income that was lower than what was achieved, if you look over in column E2, and also what was lower than what was achieved in 2023 and 2022. Also in the revision that I did create, it was also kept the same rate. If we look at the rental rate that was used, which was $43 in our assessment, if we take a look at the rent roll analysis, we can see that um, this was significantly less than the per square foot rate that was achieved at the property in 2024, which was a little over $43. To address the vacancy, we did see in the rent roll that the vacancy for 2024 was actually less than what we had projected. And when I did create the revision in column F and also in the appellant's pro forma, they also used that same reduced vacancy number, 33.9, 33,900 square feet. I did see that the unit for, I believe it was Eagle Hill, was vacating at the end of 2024. So I did include that into the vacant office NLA for the 2025 revision in column F, which was only 20 square feet off for from our original assessment. For the retail space that we did see there was high vacancy there, so we did reduce the rental rate for that down from our original of $30. Also, it came out to original for GPI a little bit higher for the vacancy rate. We did use a 13% based off of the vacant office in LA, including the Eagle Hill, which came out to 12%, which was higher than what was in 2024. Also, we did keep the same rental, operational expense rate of $9.50. And it did come out to lower than our original assessment, the final value of $352,700. So that is the 2025 assessment we're recommending. Thank you.
Okay, thank you. Questions from board members? No? Okay, any final comments, Mr. Barnes?
No, I don't have any final comments.
Okay, Mr. Warren and Mr. Chikas, if you take a minute to wrap up.
I might look like Mr. Chikas, but I'm Mr. Chitlick.
Oh, I'm sorry.
Go ahead, Blake. It's late in the season, I get it.
So, yeah, again, the overall assessment, even the revision, represents an increase, or the county's test column revised recommendation is representing an increase year over year in the assessments, when we've seen on average office assessments decrease overall in value, and specifically you're seeing the actual operations of this property significantly decrease year over year as well. Last year in 2023, the NOI reported at this property was $10.5 million. They had more vacancies, and you'll see the actual NOI decrease to $8.3 million. The county's revised test column went from $11 million in NOI to $10.6 million in NOI. We're still with $2.3 million disparity between what this property actually reported and was capable of achieving in NOI compared to the county's revised test column. Again, I think it's important to point to the county's guidelines for vacancy, and their 13% applied, where as the actual vacancy is significantly higher.
23%.
Okay. All right. Thank you both. Okay. It's just among the board. Mr. Mendez?
Yeah, I agree with the appellants that the NOI is down year over year, and I don't understand why the assessment's going up. I'm still running through some math, but I think that that's incorrect.
I don't think it's as far down as where they have it, but, Mr. Penaranda?
Mr. Mann, where do you see that it's going year after year down? You know, we're looking at 2023, 10.5 million.
Yeah, I'm just looking at the NOI from 2023, the reconstructed, and 2024 reconstructed.
9.6, okay, yeah. I was looking more realistically at that specific number to be used as the basis for the assessment for this year. I know that the appellants sometimes don't like the reconstructed numbers because it includes, you know, the vacant space that we would normally use for any other building. But the 16% vacancy that they used up on top, I think it's realistic, and you know, I'm leaning more towards that number as an NOI, to be honest.
The 9 point.
9.6 on column E2.
Okay.
I mean, that would bring the value down another pretty much close to 10 million.
Yeah, to 102 million, I believe, 515.
515, 768.
Yeah. I could go with that. I think that looks good. I was playing around with the income in E2 and kind of just substituting it in F, and it's a little bit higher, but I would be okay with that. I think that sounds fair.
And what was the final number, Mr. Penaranda?
102,515,768. It will be rounded to 800.
Mr. Yates, where are you on that?
It's interesting. I did not look at it that way.
I know, I didn't either.
I could do that. And there's logic for it, clearly. They are renting. Units are being rented.
Right, I don't see it going down. That's my concern.
Yeah.
From 109 to 102.
Yeah. I could do it, and I think this is one that I think next year is going to show a lot more. The changes on this property have been more recent, and I think that's what's making it a little more complex. I don't think the county did a bad job.
Right.
I just think that they, rightly so, were optimistic in it, and I'm not sure that's going to be the case given the market.
Right, I think it's somewhere between the reconstructed E2 and the test.
Yeah, but I'm not sure how to get there.
Mm-hmm.
Between the reconstructed and the test?
Mm-hmm.
Let me take a look. If you give me 1 minute, I'll do another number.
Yeah, that's exactly where I put it.
It's so close, but it is thousands of dollars capped out.
Another way that I was looking before to do first, but I didn't really do the numbers, was by increasing the vacancy on the reconstructed to 16%, and then just following the same path. If I do that, it brings the value down to 107,263,000 even.
Okay.
If you feel more comfortable with that, yeah, I could go with that also.
I do.
Mr. Mendez?
Yeah, like I was saying, I used the income. I mean, I don't know if anyone will go with this, but I used the income from E2 and just applied it in F, and I came up with 103,882,100. So it's slightly higher than Mr. Penrana's original number. So I'd go with that or the 102 number.
You would not look at adjusting that vacancy
Uh,
and running it in F?
I would just leave it as is. I didn't see enough to change it.
I would go with what Jose, your revision was.
Yeah, that 16% brings the actual number to 2,389,950 on the vacancy, which is, I think, higher than what they're reporting.
Yeah.
Yeah, well, I feel like we're just backing into it, but,
Would you
All right.
would you be okay with that number, Mary? The 107?
yeah, I guess, I mean, Mr. Yates, are you with that? I don't want to
I-
do reverse.
Yeah, I would do the 107. I think we're creating something on how we get to that, but I think that's probably a little more realistic. And I think next year is going to show how well they're running.
All right, Mr. Penrana, can you live with that?
Sure. I'll go ahead and move that we reduce the assessment to 107,263 even by increasing the vacancy on the reconstructed number by the county to 16%.
Okay, do I have a second?
I'll second.
Okay, Mr. Yates, all in favor? And opposed? We have Mr. Mendez in opposition. Okay, and that's because he wants it lower. The assessment is reduced to 107,263,000 even based on increasing the vacancy to 16% on the reconstruction. Okay, thank you, Mr. Bynes, and now we pick up Mr.
Thank you.
Peralta.
Ms. Dooley, or Mr. Panoranda, can you tell me the NOI that was used?
I'm sorry. It'll be 10,128,848.
And it was it kept being said the reconstruction, the column F, the revised was the one that had the, is that correct? That's what had the vacancy increased?
Right, I increased it to
All right, thanks.
16%. Yeah,
Okay, I appreciate it. Thank you.
no problem.
Okay. All right, the next case is RPC 34020290. We have Mr. Peralta joining us. So Mr. Warren, you can start with your 8 minutes, or Mr. Chitlick on this property.
Okay, I'm going to start on page 27 of 106 of the county's BOE response memo. Our summary of facts: this is the Crystal Plaza 3 property located at 2100 Crystal Drive. Consists of one individual tax RPC, currently assessed at $47,418,700. The county is recommending a revision to $35,653,800. Our requested value is $8 million, and that is based off of LOI that was signed in June of 2024. That sale is still pending, but it's expected to close in November of this year. The property is a much older property. It was originally built in 1967. Has 328,640 square feet and is 11 stories. The property, although the total square footage is 328,000, of that 254,915 square feet is office building. Also includes an additional 73,725 square feet of below grade retail space. The office is 100% vacant as of the 1/1/2025 valuation date. The county was originally valuing this property as an income producing commercial office. We're valuing it based off of the intended sale of the property, which is for land redevelopment. In the county's revision, they are now recommending a change to a cost approach, which is how they're calculating their revised recommendation of $35,653,800. This property, the owners had submitted plans in December of 24 for approval to convert the subject property, which again is 100% vacant office, into a hotel with 343 total rooms. Now, based on the county's own 2025 assessment guidelines for entitled land, the county's guidelines would indicate $50,000 a room, which at 345 a room would indicate a total value of $17.2 million. There again was a letter of intent, and we did include that. It's on page 32 of our exhibits, or of the county's memo response. That was signed June 4th, 2024 to purchase for a total of $8 million. Again, as of today, that contract is still expected to close later this year in November. The county's current valuation is based off of a cost approach to value. They are assigning a total improvement value, a total reconstructed cost to improve less depreciation of $31,340,900 for the improvement value of that 100% vacant office building, which again is being purchased for $8 million for the land. Now, our total value, or our target value that was included in our appeal package, was based on the county's income modeling guidelines for a vacant commercial office building. So what we are doing is assuming the property is 100% leased, using the county's own parameters and guidelines for vacancy, which we applied 28%, operating expenses of $11.75, which is what the county was using for estimated expenses in their original analysis when this was being valued on an income approach, and taking a lease-up deduction, assuming 100% vacant building of $32 million, which would put the value, and this is again based on the county's own assessment guidelines for 100% vacant office building, of $10,021,400. So again, the county is recommending a revision from 47.4 to 35.6, based on the county's modeling for a value on a income producing office would put the value at $10 million. There's a letter of intent on this property for $8 million. In addition, we had provided and brought this case to the board last year, and had provided a third-party appraisal from Colliers, which indicated a land value of $27.4 million. All of that significantly lower than the county's recommended revision to 35.6. And again, they're recommending valuing this property now on a cost approach at a 1967 build that is 100% vacant. Jeremy, I don't know if there's anything else you'd like to add.
Just that the assessment, the final value for the assessment is a land value of $4.3 million and improvement value of $31 million, and then indicates in the response that they're trying to get approval to build a hotel. If you look at the property where it sits as a vacant building, he's indicating that this has a value of $31 million. Obviously, this will come down to be a hotel, or completely removed every aspect of it. So the fact that they're saying the effective age of it, although it was built in 1967, is 1985, that matters on the depreciation, because they're only depreciating at 40, as if it's 40 years old. The building is not 40 years old. The building is 1967, about almost 60 years old. So if you use a depreciation of 58 years, like you would appropriately do, depreciation would be much higher. The next case, same owner, across the street, this is the building. The assessor is actually using a 60% depreciation. That building's 2 years newer than the subject. Here he's using a 59%. So the arbitrary, hey, this is a 1985 effective age, the building's going to come down. But if we're going to use a cost approach on something that's almost 60 years old, we should value it as something that's almost 60 years old, not something that's almost 40 years old. Because that's what would be rebuilt in the terms of a cost approach. But true income approach following the true county guidelines gets us to 10 million. They got it right. It's going to be purchased for 8. So just to, I think they did it right, but in this case, they said we're not going to follow that. So that's all. Thank you.
Okay, thank you. Mr. Peralta for the county, please.
Yes, good morning. This property is similar to the other properties that we heard last week in that we know that this property is going towards redevelopment. As the appellant mentions, this property applied for a conversion to hotels, about 343 rooms. And they were basing their estimation of value on a letter of intent. Now, in that letter of intent on page 35 of the packet, 35 of 106, the letter of intent, it clearly states this is a letter of intent only, and the undersigned parties shall not be legally bound by the provisions hereof. Even the appellant says that this sales is still pending. So, at which point, if it does come in before the year, before the 2026 assessment, the county would take that in consideration. Even if it comes in at the 8 million as the appellant suggests, it comes in question the motivation of the current owners, JBG. As the board may or may not know, there's recent articles stating that JBG is operating at a high debt, and even buying back dividends and repurchasing about $1.5 million in its own stock. And operating at a high debt ratio, it would speak to one of the analysts suggests it doesn't have room left to take in more debt and fund new projects. So at that $8 million price point, which is currently $10 million less than the current assessment on the land only, that would kind of speak to almost a distress sale if that were to happen. Even in after approval of this hotel, as the appellant stated, that valuation based on our guidelines would be over 17 million in the land only. Going back towards the county's approach, we did do a cost approach, as you've seen in last week's cases, that we did understand that they did apply for this conversion to the county. It hasn't been approved yet. So in valuing this property equitably with the other potential site plan approvals, we did use the cost approach, which actually used the effective age, which is current on this property. And that same approach was used across the board when using this cost approach, the effective age of the property, as in this case and in the next case. Looking at what the overall value of this property is, you can see that on our summary page, the value of the property as new was about 76 million. We depreciated about 59% based on effective age, which equated to about almost 45 million. And the total value was 35,653,800. Based upon that valuation, we did see that the value decreased a total of 39,865,400 from last year's assessment. The original assessment had a decrease of about 45.92% from last year, despite the board lowering it down to the $80 million valuation. With that, we do ask that the board confirm the revised assessment, and we're open for questions. Thank you.
Okay, thank you. Questions from board members? Mr. Mendez.
Yeah, for the county, you mentioned that the depreciation is calculated based on the effective age. It looks like the effective age is 1985. How did you come up with that 59% number from 1985? Just curious on how that works.
It is basically punched into our Marshall and Swift costing tables, and it's sort of, long story short, spits out the depreciation based on that effective age.
Okay, so it's like a calculator that's, because they mentioned the next property coming up. I assume we're going to hear that, and there's going to be a question about that too. So it's just the same calculator used for each property every time.
Correct.
Okay. And then can Mr. Chitlick chime in? It looks like he wants to say something.
Yeah, we agree that Marshall Swift is just, you put in what the age of the property is and it shoots it out. What the county does is Marshall Swift is calculated based off what the age of the property is, and they take assumptions of what's happened from a property. If you put in a building that's 100 years old, they're not valuing it as if it's never been touched in 100 years. Where the assessor errs is he doesn't enter 1967, he entered 1985, which would indicate the building would be exactly the same as if the building was built brand new in 1985. And it's not. It's a 1967 tear down essentially at this point, and that's what it. Now sitting here today and sitting here on January 1st, we knew that. So the 1985 just changes the amount of depreciation, where Marshall Swift already has all that effective age information built in.
No,
That was to me or Mr. Yates's dog, but I probably should have stopped at that point.
I'm sorry.
No, I'm used
the
to
county
it.
the county disagrees. Marshall Swift uses effective age, and we believe our records to be correct. Any renovations or improvements done on the properties is up to date on the record, and that's what we use.
And redoing a lobby that's about to be torn down is
Okay,
not
all right, I think
what
you've
they.
answered, and it is, just to confirm, it is an 1985 effective age. Mr. Peralta?
Yes.
Okay, all right. Okay, other questions? Mr. Penaranda?
Yeah, Mr. Prata, you're suggesting to do the reduction, right? Or because you said to confirm the original assessment.
I'm sorry, yes, to confirm the revised assessment.
Okay. Thank you.
Okay, all right, Mr. Peralta, then if you take a minute to wrap up.
Yes, thank you. We know and understand that this property is not going to be used as an office and not generating any income. If you look at what they reported in 2024 at $2 million, as you see in the previous years, they operated at 100% at $8.7 million. It is appropriate to use this property, to value this property on a cost approach, given that the redevelopment play is in actually, the redevelopment was approved this year, so it will go towards that. So the LOI is still pending, given that the new approval has been approved by the county. So we do ask that the board approve or confirm the $35,653,800 valuation as revised. Thank you.
All right, and gentlemen, if you take a minute to wrap up, please.
The highest and best use of this property is land. I think we all agree to that. It's a redevelopment land. It currently does not have approval, should be valued based off of the land. And if you were to value it on the income approach, you follow the county model and it gets to a value of $8.9 million. The property has a letter of intent of $8 million. There was an article that was released last week, actually 3 days ago, about JBG's debt structure. There's no relevance to that. Was brought up. I just wanted to comment on that. And they are still actively buying. They just bought a 3-property campus in Fairfax earlier this year. So it is a willing buyer, willing seller. They think it's worth $8 million. The county guidelines gets us $8 million. And it's highest and best use of land, which is around $8. There's no reason to call this a 1985 building when it's going to be torn down. The next building is 2 years newer, and they call it a 1979 building. So it just doesn't, just to arbitrarily cost approach doesn't make any sense.
Okay, all right, thank you. All right, it's just among the board. Mr. Yates.
I really should have asked this of Mr. Peralta, but why are we not looking at this at all from a land value standpoint, like we did one of the previous cases with a building on it that was also 100% or nearly empty. The value of the land, just looking at what it was for 2025, was 18,830,000, plus some value for the building. I mean, that seems to be some of the argument here, but no one's bringing up numbers. And I just, between us, that makes sense to me. Because it is a redevelopment site. And we don't know the 8 million is going to close.
Right, it's a letter of intent, and it's still, here we are in October, and
Yeah,
don't have, so.
but
don't
I
put a lot
think
of weight on that.
it's a redevelopment and it's 18 million for the land. Plus, what's something for the building?
All right, Mr. Penaranda?
Well, I was originally leaning to go to the revised number, but I mean, it does make sense. You're indicating that, like in the previous case that we've seen, that to go with the land value plus some on the improvement, but I don't know. I think that's really going way below.
But that's what it is.
Right, and it may be a year or two down the line. I don't know. I'm gonna struggle with just taking land value and slapping $1,000 on it for the building, but Mr. Mendez?
I think Mr. Yates is right, but that wasn't the appellant's argument, so I don't necessarily want to make their argument for them. And I agree that an $8 million letter of intent is, it hasn't closed yet, so we shouldn't really pay that too much attention. You know, I would probably just go with the revised number. It's already a huge drop from last year.
Yeah, that's what I think, and we'll see what
It's,
2026 brings.
I just see it's not a number that's going to actually happen. They're not going to generate that revenue. They're not going to even the value of what's existing. I think the county came up with a method. I don't think it's a good one.
Where are you, Mr. Penaranda?
I'm leaning to go towards the revised also.
No, especially
All
if you
right.
look from 87 million to 35. I just don't think it went from 87 million to 8 million.
Right. No, I mean, it's a letter of intent, we
Yeah.
don't know what's going to happen with it.
All right, then I'm gonna move to confirm the county's revised number of 35,653,800. Do I have a second?
I'll second that. Mr. Mendes.
Mr. Mendez had his hand up there. Okay. All in favor? Aye, opposed? Okay, it's 3-1 without Mr. Yates. The county's revised number of 35,653,800 has been confirmed. Really on a roll of the 3-1 votes here today. Okay, the last case on the agenda is RPC 3402644 on South Bell Street. Gentlemen, you can start with your 8 minutes and tell us about the property.
Not only 3-1, but 3-1 with different combos. This case, yeah, it's to make the comment was made. They don't want to make the argument for us, and I understand. Our whole point is that the highest and best use of these properties are land. These are land valued. They're land values with buildings on top that have no value. In the first case you heard today, there's negative value because somebody would pay more for an empty piece of land than they would for an empty piece of land where they have to remove the building. I understand if you want to take the land value and put a million on it until it's gone, that makes sense. But the fact is, yes, the values are down because the buildings now have no value to them. So they were a functioning office building, and we're told, hey, once the tenants are gone, once it's no longer a functioning office building, we will then take it to the next level. So what happens is we take it to the next level. So what's going to happen next year? Well, next year, the property is going to finally get its redevelopment approval once it's empty. And then it's going to be valued off of this huge 4.1 number. And then the land value is going to go up 500%. The sweet spot for the assessment should be what's there as of the valuation date. And what's there as of the valuation date is an empty office building that has very little value. In the first case, you'll notice the assessor actually took the land value from $18.8 million down to $4.3 million in the revised, and then added the cost. In this case, he kept the value at $18.7 million. So the land value was 18, took it to 4, added the cost value. Here, the land value was 18, left at 18, and added the cost value. That's out of equalization. So we should be looking at the land value the same on this case as we did in the last case. And if you look back at that, they just took the land value. I could pull the cost number up while you're talking. If you want to ask me during questions, hey, how did they get to, or ask Mr. Peralta during questions, how did you get to land value in the last case versus this place? I think it would really be beneficial. If you look at on this property on the income approach, though, like the county typically would do, you'll see that the value is much lower because it's essentially an empty office building that's at $36.4 million. The value of the property is the land. The building has very little value at all. Yet in this situation, the assessor is adding over $50 million in value, or just at $50 million in value for a building that we all agreed, or Blake and I agree, and Katrina, she agrees, that nobody wants. They want the land, the values in the land. So Blake, you can go ahead and finish with.
Yeah, the only thing I'll add for this one is just the kind of current status of it. This was submitted for an adaptive reuse, and the county makes indication of that in their memo. But for 1800 South Bell, it's going to be converted to 129 apartment units and 5,251 retail, ground floor retail. For 1901, 186 residential apartments and 4,692 ground floor retail. If you apply those at the county's current assessment guidelines for commercial retail at $60 a square foot, and for residential apartments that reside in close proximity to the metro at $78,000 a unit, that total would indicate a value of $25,166,580. Again, it's the current assessment on this, based off of the county's initial income model and their cost model, is significantly higher than what their, again, land valuation guidelines would indicate for this property. And if they were to value it based off of a 100% vacant office building, their lease-up model should deduct significantly more than 17 million, which the original assessment does. It'd be closer to 38 million based off of the current occupancy. So with that, I'll close. I don't have anything further.
Yeah, one more thing, just in case it's confusing, because it was really confusing to us. They reconstructed column E1 and said, well, actually the income's $18.7 million, and then took no cap rate, no lease up deduction from that. Obviously you would, but I wouldn't want somebody to look at column E1 and say, well, when you look at the income, it's went from 14 to 12 and now it's up at 18.7. It's never been up to 18.7. It's never at 18.7. And I think the assessor not adding a capitalization rate or the $40 million that would apply to the lease up on that would indicate that they don't feel that either. But in case you're looking at columns E and E1, the actual income of the property went from 12.3 to 2.1 at the property. So the assessor was originally assuming it would be 10.2 and came to a value of $78 million, then learned the income's actually 80% less than they thought, and is now offering a $7 million reduction. So taking 10% off the property after learning the income's down 80% by changing the method and using a cost approach for a building that was built in 1967, but assuming it was built in 1979, added 10 years of the effective age to a tear down, which doesn't make sense. That's all. Thank you.
Okay, thank you. Mr. Peralta for the county, please.
Yes, thank you. For this case, this property, Crystal Mall 1 and 4, 1800 and 1901 South Bell. Similar to the last case, this property is vacant or substantially vacant, looking at the property with an effective age of 1979 compared to the last property, it was 1985. Looking at the overall history of the property, when looking at years 2020 to 2023, they were operating at 81,000 or 89,000 thereabouts square feet vacant, generating over 12 million, 12.3. This year they're reporting, or 2024, they're reporting 2.1 million. So a significant amount of decrease in income based on that vacancy and based on the motivations of the owner to apply for that readaptive use for this property. I believe the comment from Mark from the last case, the county is trying to value this property based on its current state. We don't take in consideration what could happen. It's a very difficult, I guess, approach to value this property when the understanding is they're not going to be operating as an office. Even with this adaptive reuse application, even if it is approved, there is stipulation, or we've seen in another instance where a final 4.1 site plan approval has been issued or approved by the county, and the owners did not follow through with that 4.1, and they reverted back to the old use. So based on this motivation, or based on this understanding, if this property were to sell and the new owner did intend to lease up this property and put in some improvements to rent this property as an office, we can see and understand based on this this history that they can generate income. So in between this income producing versus adaptive reuse for the residential units and partial retail space, the county is justified in valuing this property with the other properties that we've seen on a cost approach. And in doing so, we did find that the total depreciation based on that effective age was about 96 million, 2,126 total depreciation from this this valuation of this property based on the cost approach. You know and understand based on last year's assessment that this property decreased 41%. There's a 41% change in value from 2024 to 2025. This reduction further adds 9% of decrease, totaling 50% from 2024. So the revised assessment at 71,085,800 is what the county feels is appropriate for this property based on equalization with the other properties that are going to redevelop. Now, as far as the land is concerned, this land at the lot was 311,763 square feet, and we applied $60 per square foot, equalized with the last case where they had, I believe, about 71,000 square feet of land there at $60. So equalized in the land valuation, equalized in the approach of cost for this property. So we do ask that the board approve the revised assessment of 71,085,800. Thank you.
Okay, questions from board members? No? Just to confirm, what was the date that the site plan change was put in? Does somebody know?
When they applied?
Yeah.
I believe it was late last year, but I'd have to go back and check. It might have been early this year.
Okay, but it still
I can't.
It hasn't been acted on.
No, correct. It has not been
Okay.
acted on.
Okay, all right, thank you. Okay, with that then, Mr. Peralta, if you take a minute to wrap up then.
Mary,
Oh,
I'm
I'm
sorry,
sorry.
my mic wasn't on. I saw 624 in here, but it has not been acted upon.
Okay, all right, thank you. Okay, Mr. Peralta?
Yes, again, we are valuing this property equalized with the other properties that are going towards redevelopment. We did use a cost approach based on the effective age, which is again the same methodology used with Marshall and Swift, our costing tables. And we do ask that the board confirm the revised assessment at 71,085,800. Thank you.
Okay, thank you. And gentlemen, if you take a minute to wrap up then.
Jeremy?
41 shows the JBG entitlement summary, and for this property, it's this says they're no longer pursuing the entitlements due to the risk of an increase in assessment, because they know if they get the entitlement, the assessment goes way up, and they're just going to hold it for a couple of years. So they've determined that they're not going to get the entitlement. We've had that conversation with Derek and the assessment office about when they're doing it or not. So all entitlements to this property are completely on hold, strictly for the assessment. Just wanted to throw that out because I was able to find that. Blake, anything else?
No, again, this property in all intents and purposes should just be valued on the land. The county's got a land value on it of 18.7 million, and that's how it would be valued at. That's how an investor would potentially look at this property as of 1/1/2025 and not under its existing use. But even under the existing use as 100% vacant office would indicate a significantly lower value based on the county's own assessment guidelines.
Is 36.4 to the point that Rob made about, well, somebody could come in and turn this back into an office. If they did, they follow the guidelines to be at 36.4. So that's it. And this is it for us for the year. So thank you. And welcome back, Irving. That's it.
All right, thank you. Okay, it's just among the board? Where is everybody? Mr. Penaranda?
Yeah, I'm okay with the revised assessment as the same as the previous case.
Yeah, no, I agree. I mean, we'll have to wait and see what happens with the site plan, if anything does. And that'll be addressed at that point. So, Mr. Mendez?
Yeah, I would agree with you too. And again, we'll see where it goes next year. I'm curious to hear what Mark has to say.
I was going to stay silent, but I also look at the tenant improvement costs on this building at $90. Not possible. I just several things, even your 50 basis point adjustment in cap. I mean, I just no.
Okay. All right, unfortunately, the rest of us don't agree with you. So
I agree.
right. I'm gonna move to confirm the county's revised number of 71,085,800. Do I have a second?
Second.
Okay, Mr. Penaranda is a second. All in favor? Aye, and opposed? Excuse me. Okay, it's excuse me, 3-1 without Mr. Yates. The county's revised number of 71,085,800 has been confirmed. And so I would just
Mary, before we go into the case for last week, I wanted to go back to case number 4, if we could.
okay.
I have checked the numbers and I did make a mistake. The revision I made lowering the assessment, it is not based on 16% vacancy. The numbers that I gave you is based on 15% vacancy. And that brought the value to 107,263,000 even. So that is based on 15% vacancy, not 16%. We can keep that to, based on the motion that we made to reduce to that value, or using the 16% vacancy, the value would drop down to 105,575,700. I didn't want to be unfair to anybody. I didn't make a mistake on that, so I wanted to go back and revise that.
Okay, all right, well, let's do this properly then. All right, having voted on the prevailing side of RPC 34020-275, I'll move to bring the case back up. Do I have a second? Mr.
A second.
Penaranda?
I'll
Okay,
second it.
all in favor? Aye, okay, so it's unanimous to bring it back up. Okay, so the case is back on the table, so the voting members here were myself, Mr. Penaranda, and Mr. Yates. Mr.
Correct.
Mendez, you were voting against this. So the question is to leave it at 15% at 107 million, or what was the other option? The 16%
At
brings it to where?
16% vacancy, it would bring down to 105,575,700.
Okay, I would lean more towards the 15% and correct it, but interested in what the other. Where are you, Mr. Penaranda? It was your motion.
No, I'm okay with the 15% because it brings the numbers actually to what I thought it was fair.
Okay,
I agree.
all right, so then we just need a motion to just to correct it. So I don't want to put words in your mouth, Mr. Penaranda, but
Yeah,
you
I'll
want-
go ahead and move that we correct the revision, I mean, to the lowering of the assessment to case 34020275, and the value would remain the same at 107,263,000 even, and that's based on the vacancy increase to 15%, not 16% as previously done.
Okay, and Mr. Yates, will you second that motion?
I'll second it.
Okay, all in favor?
All right.
Mr. Yates, there we go, and opposed. Okay, so it still remains 3-1 without Mr. Mendez. But that makes that cleaner. Okay,
Thank
so
you.
if Mr. Warren and Mr. Chitlick will stay on for a moment here. Okay, so that completes the agenda. We do have 2 other outstanding items. And so first, where it affects these gentlemen. Okay, having voted on the prevailing side of case 177, which is RPC 1403502A, I'd like to bring that back up for discussion. Do I have a second?
So,
Okay, Mr. Penaranda is a second. Okay, Mr. Penaranda, it might be easier if you just want to go ahead and explain where we are on this, so we get this correct for the minutes. Did we lose him?
Yep, I think he disconnected for a minute.
Okay, well, while he's coming back on, so basically, it was brought to Jose's attention that the numbers and the rationale that Mr. Mendez used on the motion to reduce the assessment on October 21st didn't balance. I believe he spoke with you, Mr. Mendez. Okay, and also with Ms. Roskin.
Yes,
Because
ma'am.
I believe it was you had originally brought up that it couldn't get it to balance. So essentially, as I'm understanding this, what he sent, the current expenses from the assessment increased from 24% to 4.2 million. The new NOI from the current assessment was 13,123,000. The final apartment value 263, and the total apartment value minus the PPT of the 656 was 235,616. So that is bringing down the CFA apartment value is at 1.3 million, and then the retail value of 8.6 million. So the new economic value rounded would be 245,599, 200. Is that correct, Mr. Mendez?
That's correct.
Okay, and does that balance, Ms. Roskin?
Say your last number again, please. Repeat it.
245,599, 200.
Yes, ma'am.
Okay, yep, that was in the email. So, and that was originally just for the purposes of the appellant. It was October 21st. was originally reduced to 247,714,100. So correcting the math for Mr. Mendez is actually reducing it to 245,599,200. So I assume that there's no objection from Mr. Warren or Mr. Chitlick.
No.
Okay. All right, so I believe that, oh, we got Mr. Penaranda back on here again. I
I'm
went through-
sorry, I wasn't trying to run away from it.
That's all right, I did it for you. So I guess, let's see here, who that was. We're gonna have to change the vote because we don't have Mr. Hoffman. Okay,
Right.
so Mr. Mendez, would you like to state your motion?
Yeah, I'm gonna move that we reduce the 2025 assessment to 245,599,200.
Okay, and in the absence of Mr. Hoffman, I'm going to second that motion. All in favor? I oppose none, so that is 4-0. So that assessment on RPC 1403502A has been reduced to 245,599,200. Okay, and the last case is RPC 16039,033, and having voted on the prevailing side of that case, I'm going to motion to bring it back up for discussion. Do I have a second on that? Okay, Mr. Mendez is second. All in favor? I oppose. Okay. That case is back up. That is a case for Mr. Harmon, and I believe Mr. Dubé, you are prepared to speak on what we're doing with that. We're going to move it to tomorrow's calendar. But if you could just give a little background.
Yeah, sure. It was brought to our attention that the land rate was not equalized with the surrounding properties or the abutting properties. So that was brought to our attention. And we agreed that the land rate, similar to the cases you heard today, should be equalized and set to the same rate. So we were not opposed to bringing that case back up to ensure that it was equalized.
Okay. All right. Any questions from any board members? Okay. All right. So then I'm going to move to put the case back on the agenda for tomorrow, and it's back in everybody's Dropbox for discussion, but it should be fairly easy tomorrow. So do I have a second to put it on the calendar? Okay, Mr. Yates is a second. All in favor? I oppose. Okay, so that's unanimous. So RPC 16039,033 at 1601 North Kent will go back on the calendar as the final case for tomorrow. All right, so Rosa, do you have all that?
Yes, ma'am.
Okay, all right, and Mr. Penaranda, you have that for the minutes?
Yes.
Okay, all right, perfect. All right, does anybody else have anything else? There's a lot of business we've had today. Okay, so I believe one of our longest meetings, so we will stand adjourned here at 10:53. Our next and final meeting will be tomorrow, Wednesday, October 29th at 9 a.m. in person for the board members. Thanks, everybody.
Thank you.
Thank you. See you tomorrow.
Okay.
Thank you.